Gold and silver didn't decide to rally. FX volatility forced a different class of buyer to show up, and once that door opened, the market couldn't close it without breaking something. Because while most people are staring at the headline and calling it fear or hype, the real pressure is coming from the plumbing: hedging demand, dealer risk limits, and cross-asset protection getting repriced in real time. And if you stay with me, I'm going to give you the one hidden mechanism that flips this whole story, the calendar trigger that makes the next 2 weeks dangerous in both directions, and the few price zones that matter most if this is a real regime shift instead of a flashy spike. Here's the cleanest way to frame what just happened. In January, gold didn't crawl higher. It surged from the low 4,300s early in the month toward the mid 4,600s by January 19th. Silver didn't participate. It sprinted from the low 70s into the 90s. That's not normal, and it's not just bullish sentiment. Moves like that are what markets look like when liquidity thins and someone is forced to pay up. And that's where the real story starts, because forced buyers don't buy because they love the asset. They buy because the math demands it. The moment FX volatility jumps, it changes the cost of protection across portfolios. It changes the behavior of dealers who sold that protection. It changes the risk limits of funds that target a certain volatility. And it changes the way global money thinks about the dollar, the yen, and the safe trade. Most people don't connect those dots. They see a currency headline, then a metal rally, then a pundit says, safe haven, and the brain files it away as a narrative. But markets don't move on narrative. They move on constraints. And right now, the constraint is hedging capacity. Let's start with the conflict because it matters. On one side, you have the mainstream reflex. Gold and silver are up because investors are nervous. That's not wrong, but it's lazy. On the other side, you have the skeptical crowd. This is just a blow-off. It'll mean revert. It's all paper games. That's also not fully wrong, but it's incomplete. The reality is more mechanical and, frankly, more interesting. When FX vol jumps, the demand for hedges doesn't stay contained inside currency pairs. It leaks into anything that can function as a hedge when fiat relationships get noisy. And gold, in particular, is a hedge that doesn't need a counterparty to perform its role. That sounds philosophical. It's not. It's practical. Because when FX options get expensive, when liquidity in certain pairs gets patchy, and when hedging starts to move the market instead of simply protecting you from it, managers start looking for hedges that are deep, global, and less fragile to dealer balance sheets. But that's not the part most people miss. The hidden detail, the one that reframes everything, is how hedging demand transforms into metal demand through dealer positioning and dynamic hedging. Here's the pipeline, and keep it simple. FX volatility rises, so corporates, macro funds, and asset managers buy FX options and structured protection. Dealers sell those options. When dealers sell options, they take the other side of convexity. They become short gamma in key spots. And being short gamma is a nasty job when markets are moving, because short gamma means that as the underlying moves, your hedge has to chase. Price goes up, you have to buy more to stay hedged. Price goes down, you have to sell more. That buy high, sell low behavior is exactly how volatility feeds itself. That's why you'll see volatility spikes turn into violent trends and whipsaws, even when the original news catalyst was small. Now, take that and zoom out. FX vol doesn't exist in isolation. The same dealers, the same risk committees, the same balance sheets are managing risk across rates, FX, equities, and commodities. When FX protection demand spikes, dealers don't just adjust their FX books. They adjust their cross-asset correlation assumptions. They adjust their inventory tolerance, and they widen the price of protection everywhere. That's why you can literally see gold's own implied volatility start to lift when the bid for protection shows up. It's not a vibe, it's a repricing of the hedge itself. And when the hedge's implied volatility rises, that's a signal that the market is paying up for convexity, not just buying spot because it feels safer. But here's the twist that creates the metals move. Once you're in a world where currency volatility is high, a lot of portfolios face a choice. Either keep paying escalating premiums for FX options and accept that your hedge cost is eating your returns, or shift some of your risk budget into assets that behave like macro hedges without requiring constant rolling and premium payments. Gold is the classic candidate because it sits at the intersection of currency stress, real rate expectations, and global liquidity. Silver is the higher beta cousin, smaller market, more reflex, and more likely to gap when flows arrive. And when those flows arrive, they don't politely ladder in. They hit, they seek immediacy. And that's why the tape looks like it does. But that's not the part that matters most. The part that matters is what these moves imply about positioning and the next wave of forced behavior. Because a lot of participants don't trade gold and silver as metals. They trade them as risk expressions. Levered funds express macro views through futures. CTAs chase trend signals. Systematic funds target volatility. options desks manage gamma exposure. And retail piles in late because the chart looks like destiny. When gold and silver make sharp, fast moves, you're not just watching buyers. You're watching the unwinding of previous constraints. Shorts start to cover. Vol sellers start to retreat. Dealers start to hedge differently. And suddenly the market transitions from price discovery to risk management. The difference is huge because in risk management mode, people aren't deciding what gold is worth. They're deciding what they can survive. And that's where squeezes happen. Not because of cartoon villains, because of margin, because of VAR, because of liquidity, because of we have to cut this risk today. Now, let's talk about what we can actually observe, because if you're a skeptic, and you should be by default, you need more than a story. First proof point, the FX volatility gauges. You don't have to live inside the options market to understand what elevated FX vol means. It means the cost of ensuring currency exposure is rising. It means the market expects larger moves. And it means dealers will be more sensitive to swings because their hedges will move faster and their P&L distribution gets fatter tails. When FX vol is quiet, hedges are cheap, people sell vol, and liquidity is abundant. When FX vol jumps, that whole system tightens. That's the first layer. Second proof point. You can see it in the behavior of large benchmark metal vehicles. When there are massive single-day inflows into broad gold products, that's often not retail emotion. That's allocation. That's institutional money seeking a liquid hedge, sometimes as part of a risk-off tilt, sometimes as part of a currency hedge substitute, and sometimes simply because their models just told them correlations are changing. You don't need to assume a conspiracy to understand that. You just need to understand how money moves when risk changes. Third proof point, the hedge itself gets bid. When gold volatility rises while gold rises, that's a sign that the market is paying up for protection on the move. Normally, in a calm uptrend, implied volatility can drift lower because the market is comfortable. When it rises, it often means demand for convexity is present. People aren't just buying, they're buying insurance on top of buying. That's important, because it hints that participants expect turbulence, not a smooth staircase, and that turbulence is exactly what shakes out weak hands. Fourth proof point, the physical world echo. Physical markets are messy, local, and sometimes distorted by taxes and premiums. But when you hear repeated reports of tighter availability, rising local prices, and demand spikes in major consumer regions, it's a real-world symptom that the paper move isn't tea happening in a vacuum. You don't have to hang your entire thesis on it. You just file it as a confirming signal that demand is expressing beyond screens. Fifth proof point, cross-market behavior. When currency stress rises, especially around the yen and key risk pairs, the ripple shows up in correlated hedges. The yen matters because it's historically connected to carry trade behavior. When carry is stable, people borrow low and buy higher yielding assets, and volatility gets compressed. And when carry is unstable, that unwind can be violent because it's crowded and leveraged. FX vol rising there is contagious, and in that environment, gold's role as a non-fiat hedge becomes louder, whether you like that phrase or not. But the next detail is what flips the whole setup. The calendar. The why now. Because markets don't just move because something changed. They move because something changed at a moment when positioning, liquidity, and deadlines make the response nonlinear. January is a classic regime reset month. Portfolios are rebalanced. Risk budgets are refreshed. Hedges get rolled. And liquidity can be thinner than people assume, especially when large players are adjusting exposures and size. Layer onto that month-end. Month-end fixings matter. Month-end hedging matters. If you're managing global assets, your currency hedges often get adjusted around those windows, and that's when flows can concentrate. Then layer onto that a policy calendar. Central bank meetings, especially when the market is sensitive to rates and currency policy, become magnets for volatility, and volatility magnets pull hedging activity forward. People don't wait until the decision to hedge. They hedge ahead of the decision because the whole point of insurance is to buy it before the house is on fire. So you get this dynamic where days and weeks before the meeting, the market starts repricing protection, dealers start adjusting, and cross-asset hedges start moving, and that's where gold and silver can get lifted, not because someone read a speech, but because someone priced an option. Now let's connect the macro driver without turning this into a history lecture. FX volatility tends to spike when confidence in policy stability weakens, when trade flows are threatened, or when geopolitical and fiscal uncertainty rises. Tariff threats, sudden policy ideas, uncertainty around global alliances, those don't have to happen to move markets. They just have to become plausible. Because once something becomes plausible, it changes the distribution of outcomes, and that distribution is what options price. That's why the vol market often reacts before spot markets fully adjust. It's not clairvoyance, it's math. If the range of possible outcomes widens, implied volatility rises. And when implied volatility rises, hedging demand rises. And when hedging demand rises, the mechanical pipeline into metals intensifies. That's the part most commentators ignore because it doesn't fit neatly into a 20-second clip. But it's the part that matters this week. So what does that force participants to do? Start with corporates. If you're a multinational with costs in one currency and revenues in another, FX vol rising means your risk budget gets pressured. You may choose to hedge more aggressively to stabilize cash flows, even if it costs more. That increases options demand. Now look at asset managers. If you're running global equity or bond exposure, FX vol rising can blow out your tracking error. You may decide to increase currency hedges, reduce exposure, or add macro hedges that respond to currency stress. Gold becomes a candidate. Now look at systematic funds. Volatility rising forces them to cut risk, which can mean selling equities or rates, but it can also mean shifting into assets that have different correlation properties. The key is that these are not opinions. They are rules. They are constraints. And constraints create forced flows. Then you have the dealer side. Dealers who sold options must hedge dynamically. In rising volatility, their hedging activity can amplify moves. If spot moves through key strikes, the hedging flows can become urgent. And this is where options reflexivity shows up, even if you never trade options. If a market runs into a zone where a lot of options are concentrated, hedging flows can either pin price or accelerate it. That's why certain levels matter more than others. It's not magic, it's positioning. And if this one level breaks, the math changes. So let's talk levels, but with humility. I'm not going to pretend we have perfect knowledge of every book and every strike. What we can do is identify zones that matter because they were recent memory points and because they were psychologically and technically important. For gold, the first zone is the area around the recent highs in the mid-4600s. If gold holds near that region and pullbacks are shallow, that suggests the bid is structural. The next key zone is the breakout and retest region. Think roughly the low to mid-$4,500. If gold pulls back into that region and buyers step in quickly, that's breakout memory behaving like support. If gold loses that and starts spending time below it, it doesn't instantly kill the thesis, but it changes the near-term rhythm from continuation to digestion. Then below that, the early month zone in the low 4,300s becomes important as a deeper invalidation area for the immediate squeeze narrative. You can still be long-term constructive and acknowledge that a break back into that zone would mean this move was more of a volatility spike than a clean regime transition. For silver, the logic is the same, but the behavior is harsher. Silver doesn't drift, it jerks. That's why it's the perfect emotional trap for retail. It will rip, then drop like a trapdoor, then rip again. The recent 90s zone is the obvious headline level, but the more important zones are the pullback shelves, the mid to high 80s as a first retest region, and then the low 80s to high 70s as a deeper shelf where a lot of late buyers will panic if it gets tested. And that panic is exactly what the market uses, because markets don't just discover price, they discover pain thresholds. Now let's talk market structure, because if you want to separate real pressure from noise, you watch the curve and the spreads. Futures markets have term structures. They can be in contango or backwardation. Contango is when future prices are above spot, often associated with carry costs, financing, and abundant supply. Backwardation is when spot is above futures, often associated with tightness, immediate demand, or inventory stress. Metals can be tricky because financing and convenience yield matter, but the direction and the changes in spreads can still tell you when stress is rising. When spreads start screaming, it's often because the market is trying to pull supply forward or because participants are paying a premium for immediacy. And when immediacy is bid, paper markets can get uncomfortable because paper can promise delivery later, but the real world wants it now. That's how paper versus physical tension becomes a real pricing factor without any need for dramatic claims. It's just the difference between financial exposure and actual material constraints. Silver, in particular, is sensitive to these dynamics because it has industrial demand. It has a smaller investable float relative to global capital. And it can be subject to bottlenecks in refining and fabrication that don't show up in a chart until they do. But that's not the part that matters. The part that matters is how all of this interacts with positioning and margin. When markets move quickly, the first losers aren't always the people who were wrong. They're the people who were sized too big. A short can be right, fundamentally, and still get wiped out by a squeeze because the timing goes against them and the margin requirements ratchet up. A long can be right and still puke the bottom because they bought with leverage and got shaken out. That's why talking about volatility and risk is not a boring disclaimer. It's the core strategy. This is the part where I'm going to protect you from the most common psychological ambush. Volatility doesn't just move price. It manufactures emotion. It will show you a red candle so violent it feels like the thesis died. Then it will reverse and make you feel stupid. Then it will run without you. Then, when you finally chase, it will slap you again. That cycle is how markets transfer money from the impatient to the disciplined. And the higher the volatility, the more aggressive that transfer becomes. So the rule is simple. Separate trend signal from noise. Trend signal is when key levels hold on pullbacks, when dips are bought with speed, when the market keeps making higher lows, and when macro hedging indicators remain elevated. Noise is the intraday theatrics, the headline spikes, the stop runs, the algorithmic sweeps. If you react to noise with full-size decisions, you will get farmed, and the market is very good at farming. Here's a practical shield. Decide in advance what would actually change your mind, not what would scare you, what would change your mind. For example, if your thesis is FX vol is driving hedging demand, which is lifting metals, then the confirming signals are things like sustained elevated FX, implied volatility, continued demand for protection, metals holding breakout support zones on pullbacks, and continued evidence of institutional allocation, or at least reduced willingness to sell. The weakening signals would be FX vol collapsing back to sleepy levels, the dollar stabilizing aggressively with risk on liquidity returning, metals failing key retests and starting to make lower highs, and volatility in metals falling while price falls, because that can mean the hedge bid is gone. Those are signals, not vibes. And that's where the real pressure starts, because most people don't trade signals, they trade feelings. Now, let's take a quick detour into the yen and why it's so central to this whole setup. When people say carry trade, they're talking about borrowing in a low-yield currency and investing in higher-yield assets. That works beautifully until it doesn't. It works when volatility is low and funding is stable. When volatility rises, the carry trade becomes a leveraged bet that can unwind violently. And because carry trades tend to be large and crowded, unwinds can be reflexive. Volatility rises, positions cut. Volatility rises more, positions cut more. In that environment, FX vol isn't just a currency story. It's a global risk story. And that's why a hedge like gold can become a magnet. Not because it has magical properties, but because it's one of the few assets that sits outside the direct liability structure of a particular government's currency system. That's why, historically, periods of currency stress tend to coincide with stronger gold behavior. The mechanism is portfolio level, not mystical, but I also want to give you a counterpoint because credibility matters more than hype. The counterpoint is that metals can overshoot. They can run too far, too fast. They can become crowded. They can pull forward demand, and then they can correct hard, even if the long-term thesis remains intact. Gold, despite its reputation, can be brutally volatile in the short term. Silver is even worse. The market can and will whip around violently, even if the thesis is correct. That's not a bug. It's how the market tests conviction and cleans leverage. So if you're watching this thinking, okay, this is it, straight line up, you're setting yourself up to become liquidity for someone else's exit. The smarter lens is a two-scenario framework. Scenario 1 is the controlled pullback and retest. Metals cool off, they revisit breakout zones, volatility stays elevated but not exploding, and buyers step in gradually. That's healthy. It builds structure. It gives you signal. Scenario 2 is the continuation squeeze. Dips don't fill. Pullbacks are shallow. Gaps start appearing. And price accelerates into the next liquidity pocket because shorts and underhedged participants are forced to chase. That scenario can be profitable, but it's also where people get emotionally wrecked because the swings are violent and the temptation to over-leverage is maximal. And if you're wrong in scenario 2, the reversal can be savage because squeezes don't end with a polite top. They end with exhaustion and air pockets. The next detail is what flips the whole setup in the next 1 to 2 weeks, the sequence of catalysts and the timing of hedging needs. When you have a policy calendar on deck and month-end approaching, hedging flows can cluster. Liquidity can thin at weird moments. Dealers can become less willing to warehouse risk. That's when volatility is used as a weapon, not by cartoon villains, but by the market's own structure. If you're a viewer, the way volatility will be used against you is predictable. First, you'll get a scary pullback right after a strong run. The commentary will say, see, it was a bubble. That's designed to shake out weak hands. Then, if the underlying drivers remain, you'll get a sharp recovery that makes you feel regret. That regret is designed to make you chase. Then, once you chase, you'll get another shake. And by the time you're emotionally exhausted, the market will decide the next move without you. So you need a plan that doesn't depend on being emotionally perfect. The simplest plan is this. Define your horizon, define your size, define your invalidation. If you're trading short term, your invalidation might be a break and failure of the retest zone with momentum shifting. If you're positioning longer term, your invalidation might be a collapse in the macro drivers, a sustained drop in FX volatility, and a reversion to a stable dollar regime. Different horizons, different rules, same discipline. So what should you watch next? Right now, this week, this month. Watch the FX volatility gauges. You don't need to become an options quant. You just need to know if the cost of currency insurance is staying high. If it stays high, the hedging pipeline remains pressurized. Watch the dollar and the yen for stress behavior. Sharp moves, disorderly price action, sudden reversals. Watch whether gold holds the mid $45 to $100 zone on pullbacks and whether silver can hold the mid to high 80s zone if it gets tested. Watch how quickly dips are bought. Speed matters. Slow buying suggests discretionary behavior. Fast buying suggests structural bids and forced hedging. Watch volatility in metals. If price pulls back, but implied volatility stays elevated, that can mean hedging demand remains. If price pulls back and implied volatility collapses, that can mean the hedge bid is leaving and the market is relaxing. Watch flows and headlines, but don't worship them. Headlines are often the story you get after the positioning already moved. Flows are useful because they tell you what big money is doing, but even flows can be misleading if you don't connect them to the calendar. That's the piece most people miss. A lot of institutional flow is not opinions. It's rebalancing, it's hedging, it's risk targeting. It's compliance with a mandate. That's why it can be relentless. And that's why it can reverse abruptly when the window closes. Month-end passes, the need changes, the flow fades, and suddenly what felt like a permanent bid becomes a vacuum. That's why the calendar is a catalyst. It's not the reason, it's the trigger. And once you see that, you stop being surprised by the violence. You start expecting it. Now I am going to make a statement that sounds dramatic, but is actually just market reality. The price can be lying while the spread tells the truth. When you're in a volatility regime, spot can get whipped by flows and headlines, but spreads and structure often reveal the underlying stress. If you see persistent tightness signals, whether in certain premiums and certain curve behavior, or in persistent demand for protection, you take that more seriously than a random intraday wick. Because structure is harder to fake than a candle, but that's not the part that matters most. The part that matters most is what would break this setup, because that's where risk management lives. The cleanest break would be a rapid, sustained collapse in FX implied volatility, meaning the market is no longer pricing wide outcome distributions. That could happen if policy uncertainty fades, if central banks provide clarity, if liquidity improves, and if risk appetite stabilizes. In that world, the urgency to buy hedges fades, dealers can relax, and the cross-asset bid into hedges like gold can cool. Another break would be if metals fail their retest zones and start building lower highs, while macro stress indicators ease. That would suggest the rally was more of a volatility spike than a durable trend. It doesn't mean the long-term story ends. It means the short-term squeeze narrative loses power. And if you're honest, that's what you want to watch for. Not because you want to be bearish, because you want to stay sane. Now let's bring it home with a near-term roadmap. Base case. Volatility remains elevated, gold and silver pull back modestly. They retest key zones, and buyers show up. In that base case, you want to see gold spend more time above the low to mid $4,500 than below it. And you want to see silver defend the mid to high 80s if that gets tested. You want to see dips bought with intent, not with hesitation. You want to see FX volatility stay elevated, not drift back to sleep. Squeeze case, volatility spikes again, the yen or another FX pressure point flares, protection demand surges, and metals gap higher. In that squeeze case, you'll see shallow pullbacks, fast recoveries, and a tape that feels unfair because it doesn't give clean entries. That's when people chase and get punished. If you're in that environment, the only way to not get farmed is position sizing and discipline, because you can be right and still lose if your size is wrong. And that's the part that matters. If you're still here, you're not looking for a fairy tale. You're looking for a mechanism you can track. So track this. FX volatility is not just a currency number. It's a tax on global portfolios. When that tax rises, people rearrange hedges. Dealers hedge dynamically. Systematic funds adjust risk. And gold and silver become recipients of that rearrangement, especially when policy uncertainty widens the distribution of outcomes. That's the hidden pipeline. And it is someone also why the move doesn't need a single headline reason to continue. It needs the stress regime to remain. That's the metric. That's the lens. And if you want to keep this channel of thinking sharp, less narrative, more plumbing, then stick around and add your voice in the comments with what you were watching. FX vol gauges, dollar behavior. The yen stability and whether those retest zones hold when the market tries to scare everyone out. Because the people who win in these regimes aren't the loudest. They're the calmest. They let the market show its hand. And right now, the market is quietly telling you that hedging demand is the real buyer.